This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
March roars in, well, like a bull. Stocks were supercharged following the president's speech, even though it lacked the specifics many investors had been looking for.
Turning point, Exxon Mobile becomes the first major producer to increase spending on new projects after years of suffering from low oil prices.
Sign on the dotted line. Confidence is up, unemployment is down, and that's a recipe for continued strong auto sales. Those stories and more tonight on Nightly Business Report for Wednesday. It's already March the 1st. Good evening, everybody. I'm Bill Griffith, and tonight for Tyler Matheson.
And I'm Sue Herrera. Well, the bulls led the charge on Wall Street. The Dow soared past 21,000 for the first time ever. The S&P 500 broke through the 2,400 mark midday, and the rally was sparked by two things. First, the optimistic tone struck by President Trump in his speech last night to a joint session of Congress. Second, Federal Reserve officials' upbeat take on the economy. So let's get right to the numbers. The Dow Jones Industrial Average climbed 303 points to a record 21,115. The Nasdaq gained 78. The S&P 500 added 32. And get this. It only took the Dow 24 trading sessions to move from 20,000 to 21,000, tying it for the fastest 1,000-point jump ever.
Amazing. The one thing the president did not give investors was specifics on his proposed pro-growth policies, but apparently it didn't matter because he unexpectedly gave them something else instead. And Bob Pisani explains tonight.
Stocks rallied at the open and kept it going through the close as the Trump hope trade, as I call it, is very much alive. The markets wanted more specific on Trump's proposals on tax reform, on infrastructure spending, on a reduction in regulations. Didn't get it, didn't happen. No matter. Traders almost unanimously viewed the speech as a success. The market got something that's perhaps more important. It got a speech which clearly implied that there was a good chance the president could accomplish all the goals he was setting out. Now that's been enough so far, and it was more than good enough today, as you saw. Now he spoke about more money for defense, and many aerospace and defense stocks like Boeing hit new highs. A whole group hit new highs in that group. He talked about putting a deregulation task force inside every agency. Now the biggest beneficiary of that, of course, would be banks. The KBE, or the bank ETF as it's called, hit the highest level since 2008. Then the president reiterated his desire to spend $1 trillion on infrastructure financed through a public-private partnership. No time frame on that, but infrastructure stocks like AECOM and Jacobs Engineering that had been languishing since mid-December all got a boost today. Finally, the president talked about repealing and replacing Obamacare, but he specifically talked about giving states flexibility on Medicaid. Managed Medicaid companies like Centene and WellCare were also up on the day. Now, Trump didn't offer more specifics, but the forcefulness of the speech implied he could accomplish his goals of lower taxes and infrastructure and regulatory reform, and that's why the markets were rallying. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So let's turn now to David Leibovitz for more on today's stock market rally. He is the global market strategist at J.P. Morgan Asset Management. Good to see you again, David. Welcome back.
Thanks for having me.
Let me just get your reaction. I think you heard some of the things that Bob Pisani laid out. Do you in general agree with what Bob said? And what's your impression of the move in the market today?
You know, I would agree with most of what Bob said. I think that there are really three things going on here. One, Trump's speech was very well received by the markets. Two, you have the Federal Reserve signaling that they may in fact feel comfortable hiking rates here in a couple of weeks. And three, you continue to see the economic data look fairly solid. So I believe it's the combination of those three factors which led to the market's performance today. But I think that there are still some risks out there that we need to be cognizant of. As Bob alluded to, we don't have a ton of details as to what the new new administration's policies might look like or when they may be implemented. So, they always say the devil is in the details. This time, I think the devil is in the timing. And we need to get more clarity on when these policies are actually going to come to fruition.
And plenty of respected market watchers out there who are watching this rally unfold are worried about the implications for earnings and the impact that that'll have. The earnings are still the mother's milk of the stock market out there. Is the stock market getting ahead of itself relative to earnings in corporate America is what I'm trying to ask.
I think what you're seeing is the stock market not only price in an improvement in earnings, but you're seeing the stock market now price in a change in policy. As this rally began, as multiples began to expand, what we were seeing was a little bit more optimism priced in with respect to economic growth and how stronger nominal growth would translate into corporate profits. But the major backup we've seen in multiples so far, I think, is increasing expectations around what could happen politically, which obviously creates some room for disappointment. So we still think the fundamentals are there. We're looking for mid to high single-digit earnings growth in 2017 for the year as a whole. There's some upside risk to that forecast if we get things like tax reform and deregulation a bit sooner than we're expecting. But I think that the earnings are going to be the key, because in the long run, stock prices follow earnings. So we need to see that trend of improving bottom lines continue.
In talking to one market analyst today, he said the Fed matters much less right now than it did previously, because of the aggressive agenda that the Trump administration has laid out. And if they are able to achieve some of what they have laid out, it makes the Fed not irrelevant, certainly, but much less important than it was, say, 6 months ago. Do you agree with that or not?
No, I think that's completely accurate. When I think about 2016, the first 9 months of the year, equity market performance was really driven by interest rates. You had low volatility, bond proxies outperforming. You had everybody hanging on the Fed's each and every word. Now with President Trump and the new administration in office, we have seen the focus turn to what could happen on the fiscal front. So the way that I've been explaining it to investors is, the end destination of mid to high single-digit returns from U.S. equities is probably the same, but the journey they're taking to get there is quite different. Last year, their journey took them past the Federal Reserve.
Right.
This year, they're going to be driving past the White House.
All right, David, thank you very much. Good to see you again, as always.
Thanks for having
me. David Leibovitz with J.P. Morgan Asset Management.
Well, speaking of the Fed, stocks also got a lift from a couple of Federal Reserve officials and their upbeat assessments of the economy. For one, the president of the New York Fed, Bill Dudley, said that the case for tightening monetary policy had become, in his words, a lot more compelling. And then there's San Francisco Fed President John Williams, who said he saw no need to delay raising rates. That helped lift the financial stocks, since bank stocks, of course, their profits tend to get a boost from higher interest rates. The next Fed meeting, in case you're wondering, is in 2 weeks.
And businesses are generally optimistic, but not as much as they have been. The Federal Reserve's Beige Book, which is an anecdotal look at the economy across the country, said the economy expanded at a modest to moderate pace from early January through mid-February. The report also indicated that the job market remains tight, with some districts pointing to widening labor shortages.
Also, growth in consumer spending slowed in January despite an increase in incomes. That's because rising prices hurt Americans' purchasing power. Commerce Department reported this morning that annual inflation rose to 1.9%, its highest level since 2012, and close to that Fed target.
The manufacturing sector continues to gain steam. Activity expanded at its fastest pace in more than 2 years. The Institute for Supply Management said new orders are increasing along with output.
The automotive sector certainly is a key pillar of the economy, and the latest read on auto sales shows the American consumer is not slowing down. In fact, February turned out to be another month where the annual pace of sales topped 17.5 million vehicles. And once again, trucks, SUVs, and incentives lured buyers into showrooms. Phil LeBeau has our story tonight.
With consumer confidence close to a record high, Americans are deciding it's time to buy a new car or truck. On the surface, February sales for some automakers may look unimpressive compared to the same time a year ago, especially for Toyota and Fiat Chrysler, which saw business fall almost 10% last month. But make no mistake, the number of people signing a deal for a new vehicle remains strong. And they pick trucks and SUVs over cars. Ford F-Series sales jumped almost 9%. With gas prices holding steady, Americans are looking to buy bigger models. All of this is good news for automakers who are not only selling more of their higher profit vehicles, but they've also managed to bring down their inventories, so they're in better shape heading into the busy spring sales season. Right now, most expect March, April, and May to be busy for dealerships. Unemployment is low, consumer confidence is high. A recipe for strong auto sales to continue. Phil LeBeau, Nightly Business Report, Chicago.
After years of an oil price downturn, Exxon Mobile is doing something it hasn't done in quite a while. It is increasing its spending and its investment. It's the first major oil company to do so, marking a potential turning point for that industry. But as Jackie DeAngelis reports, the move isn't without risk.
When Exxon Mobil speaks, Wall Street listens. And Exxon is talking with its wallet, confirming it will spend $22 billion on capital expenditures this year. That number up a bit from its projection. Now that crude prices seem stable, over $50 a barrel after a low of nearly $26 last year, Exxon seems to feel more confident about investing, even in short cycle projects like the Permian Basin and the Bakken.
In 2017, we expect to spend $22 billion. This allows us to advance investments and adjust either up or down to commodity prices, price conditions, and cash flow. More than 1/3 of the CapEx will be invested in advancing our large inventory of short cycle opportunities. They are primarily Permian and Bakken unconventional plays and short cycle conventional work programs. This component of our investment plan is expected to generate positive cash flow less than 3 years after initial investment.
But risks continue to plague the industry. While OPEC members have trimmed production and their cooperation has impressed markets, concerns about increases in U.S., Russian, and Nigerian production worry the market. That means that the delicate dance between supply and demand will continue, and if big oil acts over aggressively, the danger is it could flood the market with oil once again.
We use a proven development planning process to enhance commercial potential and competitiveness over a range of economic conditions.
Today, the Department of Energy released its weekly crude inventory data. In that report, U.S. production is holding over 9 million barrels a day, increasing steadily over the course of the last year. Consider that OPEC's cut is a max of nearly 2 million barrels per day. It's a reduction that could easily be eclipsed by non-OPEC producers. What this tells us is that players like Exxon, Chevron, Hess, and others are shouldering a big responsibility. Their actions could swing a market that has struggled to find its footing. For Nightly Business Report, I'm Jackie DeAngelis.
Exxon Mobil's CEO also told investors that the new short and long-term projects should continue to help fund Exxon's 106-year-old dividend.
Still ahead, the president calls for a fundamental change to legal immigration. We'll talk about the potential impact that has on business and the economy.
Wells Fargo executives will see no cash bonus for 2016. This as the bank looks to increase accountability following the fake account scandal. Compensation received in 2014 will also be partially clawed back. Those affected include CEO Tim Sloan, the bank's CFO, and 6 other top lieutenants.
Snap, the parent company of the popular messaging app Snapchat, priced its initial public offering above its target range tonight. The company also raised more than $3 billion, giving Snap an approximate valuation overall of $24 billion. But a lot of questions still remain about this high-profile IPO, including how it's going to make money. Julia Borston takes a look tonight.
Snapchat says it reaches more than 40% of 18 to 34-year-olds in the U.S., and it earns revenue in 4 ways: Snap ads, lenses, geofilters, and spectacles. Its biggest business, Snap ads, which run between stories from friends or brands. They begin with a full-screen video ad of up to 10 seconds, with the ability to swipe up for more options. Snap says more than 60% of these ads are watched with the sound on, reporting an ad watched as soon as it loads.
Snapchat pioneered the use of sponsored lenses, like this one for the NBA All-Star Game, using augmented reality to put a brand on top of a user's face.
Snapchat charges a daily flat fee for these, reporting how many users played with the filters and sent them to friends. Sponsored geo-filters target people within a specific location, like a concert or mall, layering an image on top of photos. And the self-described camera company now sells these $130 spectacles, which capture video. With only a limited number available, they haven't yet generated significant revenue. For Nightly Business Report, I'm Julia Borston.
Mylan forecasts a strong 2017, and that's where we begin tonight's market focus. The maker of the allergy medication EpiPen is predicting that profit and revenue for the year will come in above analysts' expectations. The company citing strong demand for its generics business as well. It also reported better than expected fourth quarter results. The shares rose 7% to $44.87. Technology is the centerpiece of McDonald's new growth plan. That company will invest in digital ordering and delivery options in an effort to drive customer growth. The company also said it's continuing to trim overall administrative costs. The shares rose 1% to $129.05. Best Buy said weak demand for video games caused the electronics retailer to miss revenue estimates and post an unexpected decline in same-store sales. The company also warned of another drop this quarter, but still, it hiked its quarterly dividend by 21% to 34 cents a share. Shares were off 4.5% to $42.14.
Home improvement retailer Lowe's said more customers spent a lot more money at its stores in the most recent quarter. As a result, profit and sales topped expectations, and the company said the year ahead looks strong as well. Lowe's shares popped more than 9% in today's strong trading. It's at $81.45. And American Eagle Outfitters issued a downbeat outlook for its same-store sales and said that it's facing a challenging retail environment right now. The company added that it expects same-store sales for the current quarter to be flat to down in the low single digits. But there was some positive news. Its Aerie brand saw a double-digit rise in sales. Wasn't enough, though. Shares slumped by 9.5% on an otherwise big up day to $14.34.
President Trump, in his address last night, called for a change to the U.S. immigration system. He wants it to be merit-based. That means immigrants are selected based on their merit and skills, similar to the process used in Canada and Australia.
Switching away from this current system of lower-skilled immigration and instead adopting a merit-based system, we will have so many more benefits. It will save countless dollars, raise workers' wages, and help struggling families, including immigrant families, enter the middle class. And they will do it quickly, and they will be very, very happy indeed.
Supporters of a merit-based approach argue that the current system increases the supply of low-skilled workers and pushes down wages of those at the bottom. Critics say the current system has successfully allowed immigrants to take advantage of U.S. opportunities.
So what impact would a merit-based immigration policy have on the U.S. economy and businesses? Josh Feinman is global chief economist at Deutsche Asset Management. He joins us tonight to talk about this. As we mentioned, this is already in use in various forms in Canada and Australia. Would we use the same blueprint, and would it be enough to move the dial for industries like technology, which keep saying they don't have enough skilled workers out there?
Well, I think that from an economics perspective, a merit-based system has much to recommend it. Now, of course, the devil will be in the details. We'll have to see, how big of a system they're talking about, how aggressive they're going to be. But the basic idea of tilting your immigration towards higher skilled folks, I think makes a good deal of sense. You're talking about people who would have greater inclination and ability to work, people for whom many firms, would be very, aggressively looking to hire them. These people tend to be younger, more entrepreneurial, higher productivity. So I think it would be accretive to growth for the economy as a whole.
What about those critics of that merit-based system that say it discounts the immigrant who may be less skilled but comes into the United States with a greater desire to change their life, and therefore they start more small businesses and they tend to maybe work a little bit harder at the bottom rung? Do you buy that, or maybe it's a combination of both?
I think it is a bit of a combination of both. And look, I think there's a case to be made for having, both types, for sure. But I think so far the dial's been tilted more towards the lower skilled, and we've seen in in recent decades a greater share of the immigration has been in that category. So, and that has benefits, some of which you mentioned, but also has some downsides. And one of them is it does tend to pressure some of the wages of lower skilled Americans. And that is only one, a small component of the contribution towards widening inequality. So if you tilt things towards the higher skilled, you actually have the potential to mitigate that a little bit and increase the supply of higher skilled workers.
Josh, let me ask Sue's question from a slightly different angle. There are those who say that the lower skilled workers are willing to take the jobs that many Americans don't want, whether it's in agriculture or fast food, you name the industry that are for low paying jobs to begin with. What about that part of this equation right now?
Oh, I think there's an element of that for sure. And that's why I don't think that a wise policy would be to shut the door to lower skilled immigration. I think you need some of both. But maybe the balance has been more tilted towards the lower skilled, predominantly. And now maybe, sort of balancing that a little bit more towards the higher skilled makes a little bit of sense. But I agree, you don't want to shut the door completely to the lower skilled.
Josh Feinman of Deutsche Asset Management, thanks for joining us tonight.
Thanks for having me.
Coming up, sinkholes, eroding dams, why California's crumbling infrastructure is in need of a big fix.
Last night, President Trump also reiterated his pledge to ask Congress for a $1 trillion infrastructure package, and that sent shares of stocks like Dow component Caterpillar, U.S. Steel, and Alcoa higher. If legislation is passed on that, many states would be pushing to have their projects funded. And as Aditi Roy reports for us tonight, after a winter of brutal storms, California's infrastructure, for one, may be in desperate need.
A gaping sinkhole in the middle of an interstate, an eroding spillway of the Oroville Dam, nearly causing a catastrophic dam failure and prompting a mass evacuation, and highways ravaged by rain and mudslides. Those examples from California's brutal storms this winter caused an estimated $500 million worth of damage. They're also the most recent cases of what Governor Jerry Brown calls the state's crumbling infrastructure.
We've got dam spillways eroding. We've got roads crumbling. We have our aging infrastructure, and it's maxed out. What's required is to take some immediate action, which we're doing, and then over the longer term, we have to invest billions of dollars in California infrastructure.
He's asking the federal government for help. Brown, a vocal critic of President Trump, recently sent a letter to the president requesting expedited environmental review of 10 high-priority infrastructure projects for California, which makes up the world's 6th largest economy, according to the state's finance department. Part of the problem? Some say the state hasn't been spending enough to maintain roads. The governor estimates California highways need $59 billion worth of deferred maintenance. The American Society of Civil Engineers, which comes out with a report card on the country's infrastructure every 4 years, gave failing grades to the Golden State in its most recent report from 2013. California got a C- in transportation and a D for levees and flood control. Among the projects making the governor's list for the White House, emergency repairs to the eroding Oroville Dam spillway and California's high-speed rail project, which itself has faced numerous roadblocks in funding and political opposition. The governor's office also estimates California's local streets and roads need $78 billion in repairs, and its flood control system needs $50 billion worth of improvements. Governor Brown hoping infrastructure is one area he and the president can agree upon. For Nightly Business Report, I'm Aditi Roy, San Francisco.
Some sad news to pass along tonight from our Nightly Business Report family. Longtime anchor of this program, Paul Kangas, passed away yesterday at the age of 79. He was a pioneer in broadcast business news, and his unmistakable style helped make NBR the most watched daily business program on television.
This is the Nightly Business Report. Kangas joined Nightly Business Report in 1979, beginning a 30-year run. His deliberate, measured style helped NBR become the first business program to build a mass audience.
As panic selling erupted on those foreign stock exchanges, as you just heard, prices on the New York exchange continued to plunge early today.
In a phrase, Kangas was business news before business news was cool on TV. In 2009, the year he stepped away, Kangas was presented with a Lifetime Achievement Award in Business and Financial Reporting by the National Academy of Television Arts and Sciences. A Michigan native, Kangas graduated from the University of Michigan and served in the U.S. Coast Guard during the early 1960s. After studying at NYU's Stern School of Business, he earned a stockbroker's license and later began his career as a broadcaster at a CBS radio affiliate in Miami. One of the first to share a passion and his expertise in the stock market as a broadcaster, Kangas was known for many things, but perhaps for nothing so much as his signature sign-off.
I extend to all of you my wishes for the very best of goodbye.
Nightly Business Report has been funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt. To move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.